It's definitely an unsettling environment for some when the market is acting like it's acting. Down, stocks that have been proven winners the entire year, all of a sudden yielding losses, and sectors that seem to be well priced even getting hit. However, I'm looking at various facts and making various judgments and sticking to that while only passively observing the movements that may cause emotions and pain to run high. I'm not ignoring them. I'm definitely viewing them, and I'm not ignoring the presence of pain. This time in the year, it's plentiful, but our job is not to worry about that and worry about pain. Our job is to yield the best results and focus on the truth. And there's several things that we have to be aware of. Like one, some of you may be conscious of the notion of the quad witching. It's the third week of the last month of every quarter when every kind of derivative essentially expires on the same day. That third week of the last month of the quarter happens to be this Friday. We've kind of been hit with the perfect storm the past 2 weeks. Let's put things in perspective. We got Omicron the day after Thanksgiving. Arguably the least energetic day in the stock market at all. We then had oil drop 13% in a single day, and the stock market just totally puke. And that kind of carried over into the following week. However, after that, we had oil break a 6-week losing streak. And there's a lot of reasons to hate oil. There's the Strategic Petroleum Reserve. There's the President of the United States saying things are going to go down and, yada, yada, yada. However, these are all sounds and noise. In the grand scheme of things, they have very little effect. We've had Strategic Petroleum Reserve releases in the past. They've not had impacts. We've had Delta waves in the past, Corona waves in the past, and since April of 2020, they have had very little to no impact on the oil market. We've had scary new variants. However, this one appears to be significantly less scary. Now, the Fed is meeting tomorrow. This is certainly an important meeting, and I'm going to be watching it. And I'll be talking about it again tomorrow, so make sure to tune in. However, I don't think this meeting is a true surprise to me, to you, who's been listening to this channel, and to my clients. I think it's a surprise to people who are in the inflationist transitory camp. They were the ones who were surprised that week after Thanksgiving when Jerome Powell decided to retire the word transitory. If you've been following this channel for a long time, you may remember the "it's transitory" hat as a joke, as sarcasm. We have been very bullish the inflation trade, and unfortunately we actually have been burned for that. My clients have experienced losses on our options on a 20-year short bond treasury ETF. Maybe that'll begin to reverse, and maybe we'll close that in the green. We will see. But if you're watching this channel, you have experienced pain. You may have been with me through that pain. I'm here to tell you that I see everything is okay. I see the price of oil remaining above 80, or 70 rather. I see the price of oil down today quite largely, and stocks rebounding after yesterday's losses. What does that tell me? Yesterday's losses were a little bit overdone, and there's nobody left to sell. At least in the morning, we did trail off. It's not like there's an absence of sellers, but there's no panic sell left, it seems to me. We'll see, but I think the weak hands are few left in the energy space, and this is part of our more long-term thesis. Remember, we are in this position for a multi-year return. This is not we just got to get our bag and dip. No, this is a multi-year return. Exxon is my biggest position for my clients. If I get a good return this year for them and collect fees, I will be buying and exercising my deep in the money Exxon calls, which on a valuation of stock basis are my biggest personal positions. So we're very bullish Exxon and the energy space going into next year. For perspective, just because I don't talk about my personal portfolio as much as I probably should, it is 99.9% energy options at this point in time, believe it or not. I am that bullish. I'm not talking out of my ass. I am that bullish. And 0.01% Dogecoin. That is my personal portfolio mix. My clients have a much more reasonable portfolio mix. Exxon is our largest position at about 8 and some change percent. Following that is MP, a mining company of rare earth metals used in electric vehicles and possibly future drones. So we are well diversified, but we're very concentrated in two particular types of stocks. And these stocks I like, and despite pain that we may have experienced in them, I still like in a rising rate environment. And I'm going to talk about why, because it's important for you to know how I'm positioned. One of the two baskets is the energy mining companies basket. This is the larger of the two baskets at the moment and the only one with options. Why do we like these companies? Well, as rates rise, the demand for immediate cash is going to increase. Exxon has said they expect to double earnings. Double earnings. It's a cheap company relative to earnings already, but they're going to double them. Earnings over the next few years. They're probably going to increase their dividend again. Maybe they'll increase buybacks again. Regardless, the stock is priced well. And they've got long-term potential through carbon capture and new forms of energy, which they are investing quite heavily in and focusing on a lot. In addition, we've got mining companies. We already talked about MP. We like steel. We like copper. We like materials that are hard and can adjust with the obvious inflation that's occurring and should benefit as tech stocks fall and demand for cash rises. We like that dynamic. However, we're not leaving all tech. And this is our second basket, which actually has no options because we have to throw out timelines when we're thinking in this basket. We have to focus on valuations almost exclusively and begin to think like a venture capitalist. We want to look for good technologies, not an investing trend, right? We're not looking at Zoom because there's a pandemic. We're looking at technologies that we expect will do well in the 5-year and beyond time horizon that are very cheap now and very young now, but have a high chance of success. We look for lower risk and disproportionately higher reward. For example, CRISPR therapeutics, which we've talked about, the ability to edit genes means you can cure, hypothetically, all genetic disease. That is a massive, massive total addressable market and potential technology. So buying it for $5 billion seems like a pretty fair bet to place, in my opinion. That is the type of company we're putting in the other basket. So, good companies that are well priced and earning a lot of money as the demand for cash goes up, because it will, and companies where, why would you even think about interest rates? What does interest rates have to do with it? That are reasonably well priced, because if they're not, interest rates will have something to do with it. Good thing, there's been a large swath of the market that has anticipated this rate increase, and they've been dumping everything in tech. So if you happen to find something that you think is a 5-year technology and it's down, it could be a good time to add. That's your decision. That's today's video. We'll be back tomorrow after the meeting. And until next time, Peace out.